and welcome to another episode of Classroom. Today we're shifting gears a little bit and talking about something we haven't in the past. Currency, and not just currencies, but currency futures as well. Relatively new phenomenon in India, but very, very vibrant, liquid, and perhaps the largest traded market globally, which is why you need to understand what it's about and whether you as well can participate in the process. Packed house today then to talk about currency futures. Anant Narayan of Standard Chartered Bank, U. Venkatraman of MCX Stock Exchange, and Jamal Maklai as well, all joining in with their thoughts on how to go about this entire process. Definitions first for this entire process. Anant, let me start with you. How would you define currency futures and what is it intended to do?
Well, let's start with what is a currency in the first place. As we all know, as long as we have global trade and we have global capital flows, we encroach into each other's currencies. There is a need for a currency market, much like we have a commodity market, where the price of one currency can be expressed in terms of the other. The futures market is a derivative of that. Basically, you trade contracts on the exchange, much like you do the equity and commodity contracts. And these are standardized contracts against a margin and so on and so forth. But overall, clearly this market is a huge market, the largest asset market in the world, 24/7 if you exclude the weekends. If you wake up in the middle of the night, you'll see currency markets moving between New York close and Tokyo open. So it's a very vibrant $4 trillion per day volume market overall. If you include derivatives, it's a pretty large multi-bagger. So it is probably the most important market in the world today.
Jamal, the reason that's given often in terms of currency futures and why it's important is the arbit term hedging. How would you define why currency futures are important and why they're such an important tool universally now?
Well, actually, if you look globally, currency futures are not a hedging tool. They are basically a speculative tool. The market, Anant was talking about the $4 trillion, is actually not currency futures, the total currency market, which is the OTC market, most of it which is between banks and large corporates. And a smaller fraction of it is the currency futures, but it's still a huge amount, right? Now, while theoretically the currency futures market can be used for hedging, and globally, certainly in some countries, for example, Mexico, etc., the currency futures are used for hedging. You can judge that from the fact that the open interest is sort of when someone takes a position and carries it for, let us say, 2 days, 3 days, 1 month, 2 months, obviously they're doing that. They could be speculating, but they could also be people who are looking to lock in a price in the future. But the vast bulk of currency liquidity is intraday, meaning you buy now and you get out in 20 minutes, right? Now that's not hedging. That's trading. That's speculation. Nothing wrong with that. We're all here in, markets to make money. And I think in India, today, thus far at least, the currency futures market, which has done very, very well, it has grown to, I think it grew up to about $7 billion a day in about 3 years or 2.5 years, was almost 100% speculation, right? There's been a fallback in the volumes because of some stamp duty issues, but the market is still very liquid, but fortunately or unfortunately, it's still largely speculative. I think to make it meaningful for hedgers, RBI needs to make a few structural changes.
Venkat,